I think it's important for us to understand the relationship between growth stocks and market cycles. The relationship between growth stocks and market cycles. So we start with the introduction, number one. So growth stocks react differently to economic cycles. Understanding this pattern, can help investors navigate market conditions and make strategic investment decisions. When you understand how economic cycles, affect growth stocks, that will help you to be able to make a better informed investment decision. Number two is, what are growth stocks? What essentially are growth stocks? Growth stocks are companies expected to grow faster than the average growth rate of other stocks in the same sector or in the overall market. They grow faster than other stocks. They typically reinvest earnings into expansion rather than paying out dividends. They aim for significant capital appreciation. Instead of paying out dividends with their profits, they plow back their profits to do what? To encourage more growth and expansion. Number number three, growth stocks and market cycles. That's the core idea of this video. Growth stocks and market cycle. So when it comes to the expansion phase of the market cycle, growth stocks tend to thrive during economic growth, driven by increased consumer spending, innovation, and lower interest rates. Lower interest rate encourages borrowing, and as people borrow, the more they borrow, the more they spend, and this spending will further fuel the growth of growth stocks. So you have the peak phase of the economic cycle. So at the peak phase, let's look at the behavior of growth stocks. As the economy peaks, growth stocks can face volatility. At the peak of the economy, they face increased volatility. So high valuations and market saturations. Saturation can lead to slower growth, but they may still perform well if investor optimism persists. So when they grow to the point where their value becomes, they become overvalued, then the growth rates may decline, but it may still continue if investors believe that the company could still grow further. But mind you, stocks don't grow to the sky. Eventually, it will still come down. So at the recession stage of the market cycle, you discover that growth stocks are hit harder during recession due to reduced demand and lowered, growth expectations. People tend to moderate their expectations concerning the stock, and that sentiment will force the price to go down. So investors may shift to safer, value stocks. They may switch from growth investors to value investors. Then the last phase is the trough. The trough is very, bottom. The trough phase of the economic cycle. As the economy recovers, growth stocks can lead the rebound, benefiting from renewed, investor confidence, lower interest rates, and fresh, opportunities for expansion. So generally, lower interest rate will will encourage investors to borrow and invest in the markets. So that will breed a kind of renewed optimism, renewed expectation, and sorry, renewed investor confidence in the market. Number four is why growth stocks are sensitive to market cycles. Why growth stocks are sensitive to market cycles. Growth stocks are more volatile because of their value is based on future growth projection, future growth expectations, which can be easily disrupted by markets or by economic shifts or phases in the economic cycle. So interest rate changes, also significantly impacts the performance of growth stocks. Number five, managing growth stocks investments. Managing growth stocks investments. So you adjust portfolio allocation based on market conditions. So favor growth stocks during expansion and recoveries while shifting to more defensive or value stocks during downturns. During time of economic downturns, it's advisable you go for value stocks, neglected stocks, disregarded stocks, but with solid fundamentals. So diversify across sectors and focusing on companies with strong fundamentals can help reduce risk during economic uncertainties, during uncertain times. So in conclusion, growth stocks can provide substantial returns during period of economic expansion and recovery, but are more volatile and vulnerable in recessions. Understanding these cycles also, allows investors to make more informed choices about when to invest in growth stocks. So you invest when the economy is at the expansion phase. You may equally invest when it is at the peak phase. And also at the trough phase, you may equally invest in growth stocks because these stocks are about to recover at that stage.